Basics of Investing. Chapter 8, Trading Systems and Strategy Design. Section 1, Strategy Types. Most trading strategies begin with a simple belief about how prices tend to behave. Trend following starts from the idea that strength can continue, so the goal is to join a move that is already underway and stay with it. Mean reversion starts from the opposite idea. When price stretches too far from a typical level, it often snaps back, at least in quieter markets. Breakout strategies focus on moments when price escapes a range or key level, on the belief that compression can lead to expansion. Each type creates different entry rules, exit rules, and risk patterns. The important lesson is not to search for a universal strategy, but to understand which logic best matches the market you are trading. A trend-following strategy tries to capture the middle of a sustained move rather than picking the exact top or bottom. It assumes that once a market shows clear direction, buyers or sellers may keep pushing in that direction for longer than expected. Traders often use tools like moving averages or ADX to help define whether a real trend is present and how strong it may be. In a clean upward trend, the strategy may keep buying pullbacks or holding as long as price remains above a trend filter. The trade-off is that trend following usually struggles when markets move sideways, because price keeps starting and stopping without real follow-through. Those repeated false starts are called whipsaws, and they are one of the main costs of using this style. Mean reversion is built on the idea that extreme moves often cool off and drift back toward a more normal level. Instead of buying strength, this approach often buys after weakness or sells after a sharp stretch higher. Traders may use tools like RSI or Bollinger Bands to define what counts as unusually extended. This tends to work best in range-bound markets, where price moves back and forth between support and resistance without establishing a lasting trend. In that environment, fading extremes can produce many small, controlled opportunities. The danger appears when a market is not merely stretched, but actually beginning a strong trend, because what looks overbought or oversold can stay that way and keep moving further. A breakout strategy focuses on the moment price leaves a clearly defined area, such as a range, channel, or important level. The logic is that quiet periods often store up pressure, and when price finally escapes, a larger move may begin. Traders usually look for confirmation, such as a close outside the range or stronger volume, to reduce the chance of reacting to a brief false move. Breakouts are often most useful when market conditions are shifting from calm to active. The challenge is that many breakouts fail quickly, with price popping through a level and then falling back into the range. Because of that, breakout systems usually need precise trigger points and disciplined exits when follow-through does not appear. The same market can reward very different strategies at different times, which is why market regime comes first. In a steady directional environment, trend following often has the clearest advantage because persistence matters more than precision. In a quiet range, that same trend logic may produce repeated false entries, while mean reversion can work much better by fading moves near the edges. During transitions, when a market shifts from compression to expansion, breakout strategies may become the better fit. This is why strategy design should begin with a question about environment rather than indicator choice. Are prices trending, rotating in a range, or preparing to expand? Matching the strategy to that answer usually matters more than finding a clever signal. Once you choose a strategy type, the rules should support the core logic of that style. A trend-following system often needs entries that confirm direction, along with exits like trailing stops that give a strong move room to continue. A mean reversion system usually aims for smaller moves back toward average, so it often uses tighter targets and clearer thresholds for entry. A breakout system depends on well-defined trigger levels, because a vague breakout rule is hard to execute consistently. It also needs a plan for failed breakouts, since a fast return into the range often means the original idea is no longer valid. In other words, risk management should not be generic. It should be built to serve the specific behavior your strategy is trying to capture. A single market like Euro/USD can illustrate why strategy fit matters so much. In a strong uptrend, trend-following logic may work well because buying in the direction of momentum allows the trader to stay with a persistent move. If that same market shifts into a sideways range, those trend signals may start failing over and over as price reverses before gaining traction. Inside that range, mean reversion may become more useful, especially if price repeatedly bounces between support and resistance. Then, if EUR/USD finally pushes above range resistance with real follow-through, breakout logic may become the more appropriate approach. The market did not change its identity as Euro/USD, but its behavior changed. That is exactly why strategy choice has to be tied to conditions, not to the instrument alone. No strategy works everywhere, because every strategy is designed around a particular kind of market behavior. Trend following is strongest when direction persists, but it tends to bleed small losses in sideways conditions. Mean reversion can do well in calm ranges, yet it can be badly exposed when a strong trend keeps extending. Breakout systems can capture powerful moves, but only when the breakout actually leads to sustained follow-through. The practical goal is not to find perfection, but to understand where a strategy has an advantage and where it becomes vulnerable. That is why testing across multiple environments matters so much. A useful strategy is one whose strengths and weaknesses are understood in advance, not one that looks flawless in a narrow sample. Imagine gold future spending 3 months moving between about 1,980 and 2,040, while 80x stays below 20 most of the time. That combination suggests a weak trend, range-bound environment rather than a market with strong directional momentum. In that setting, mean reversion is the most natural strategy type, because price is oscillating within boundaries instead of trending away from them. A trader might look for buying opportunities near support and selling opportunities near resistance, always with clear risk limits in case the range breaks. Trend following would be more vulnerable here, because repeated attempts to ride a trend could turn into a series of whipsaws. This example shows how strategy choice should begin with reading the environment correctly. Before asking how to trade, it helps to ask what kind of market behavior is actually present. Section 2. Rule-based versus discretionary. Trading style is often presented as a choice between rule-based and discretionary, but in practice it is better understood as a spectrum. At one end, a rule-based approach uses predefined conditions that tell the trader exactly when to act and when to do nothing. At the other end, a discretionary approach relies more heavily on interpretation, context, and judgment in real time. Most real-world methods sit somewhere in between, using fixed structure for some decisions and human judgment for others. That is why the most useful question is not which label sounds better. The better question is what parts of the strategy are fixed and what parts are left to interpretation. Role-based trading means the system tells you what to do before the trade ever appears. If the required conditions are present, you take the trade. If they are missing, you stand aside. Entries, exits, stops, and position sizing are defined in advance, so the decision process becomes much more consistent. This reduces the influence of fear, hesitation, excitement, and other emotions that often distort execution. Two traders following the same rules should reach very similar conclusions on the same chart. That does not guarantee profits, of course, but it does create a method that can be tested and repeated. In strategy design, that clarity is a major advantage. Traders are often drawn to rule-based systems because clear rules make a strategy easier to test and easier to follow. If the rules are specific enough, you can apply them to historical data and measure things like win rate, drawdown, average trade, and consistency across time. During live trading, the same structure can reduce fatigue, second guessing, and the tendency to improvise under pressure. Role-based methods are especially useful for traders who want discipline and repeatability. The main weakness is rigidity. A system can keep firing signals even when the market environment has changed and the original logic is no longer a good fit. So the strength of precision can also become a weakness if the rules are applied without awareness of changing conditions. Discretionary trading uses a framework, but the final decision depends on judgment in the moment. A setup may meet the basic conditions, yet the trader might still ask whether the chart quality is clean, whether volatility is abnormal, or whether a news event could distort the trade. In that sense, discretion is not random. The rules still guide attention, but judgment decides whether the opportunity is good enough to act on. This flexibility can be valuable in markets that do not behave neatly or when important context is hard to encode into strict rules. The cost is that two similar setups may not be handled the same way, even by the same trader on different days. That makes discretion powerful but also harder to measure and control. Traders use discretion because markets often contain context that is difficult to capture with the checklist alone. A discretionary trader may avoid a setup that technically qualifies but appears unstable, poorly formed, or exposed to unusual news risk. That flexibility can help in situations where rigid systems would take weak trades simply because the rule fired. The problem is that discretion also opens the door to bias. Confidence after a winning streak, caution after losses, or a strong opinion about the market can all distort decision making. As a result, two nearly identical setups may produce different choices. So, discretion can improve adaptability, but only if the trader has enough self-awareness and process discipline to keep judgment from turning into inconsistency. Many traders do not choose one side completely. They build a hybrid approach that combines fixed rules with selective judgment. For example, market selection might be discretionary, with the trader choosing which assets look clean or active, while the actual entry trigger is fully rule-based. Some traders also keep exits partly discretionary, especially when deciding whether a trend still looks healthy, while holding risk limits and position sizing to strict rules. That can create a useful balance between consistency and flexibility. The key is to be deliberate about where discretion is allowed and where it is not. A hybrid approach works best when the non-negotiable parts, especially risk control, remain fully defined. Building a strategy becomes much easier when you define each decision point intentionally. Start with the market behavior you want to trade, such as trend continuation, range reversals, or breakouts after consolidation. From there, decide whether the method should be mostly rule-based, mostly discretionary, or a mix of both. Then specify the practical parts: how you enter, how you exit, how much you risk, and how you size positions. Once those pieces are in place, the strategy can be tested, reviewed, and refined with evidence instead of intuition alone. This sequence matters because it turns a loose idea into an actionable process. A strategy is really just a chain of decisions that has been made clear in advance. Testing looks different depending on how structured the approach is. Rule-based systems are easier to backtest because the decisions are explicit and can usually be applied mechanically to historical data. Discretionary methods are harder to test that way since part of the process lives in judgment rather than in exact formulas. That means discretionary traders often need a different kind of evidence, such as journals, screenshots, notes about context, and records of why they took or skipped a setup. The goal is still consistency, but the review process focuses more on whether the trader followed the intended method than on whether a script would have taken the same trade. In other words, less formula usually means more record keeping. Without that record, it becomes hard to tell skill from selective memory. The same trade idea can lead to very different execution depending on how much structure is used. Imagine a TSLA setup based on an RSI signal. A rule-based system might define exact thresholds and take every valid signal automatically, which makes the process highly consistent and easy to test. A discretionary trader could start from the same RSI idea, but then judge whether support is nearby, whether volatility is excessive, or whether recent news changes the quality of the setup. That flexibility may improve selectivity, but it also makes the process harder to evaluate objectively. Neither version is automatically better. The real question is whether the chosen style matches the trader's ability, personality, and testing discipline. Most problems come from misusing an approach rather than from choosing the wrong label. Some traders call a strategy discretionary when they are really using judgment to excuse weak rules or inconsistent behavior. Others create rule-based systems that are so heavily optimized to pass data that they cannot survive commitment. A common failure is ignoring rules whenever a valid signal feels uncomfortable, which destroys the value of having a system in the first place. Discretionary traders face a parallel risk when they trade without structure, records, or clear limits. The lasting lesson is that both approaches can work, but only if they're applied honestly, reviewed carefully, and matched to the market conditions they're meant to handle. Section 3. Entry/exit rules. Every trading strategy needs clear answers to two basic questions: when to open a position and when to close it. Those choices shape almost everything that follows, including risk, reward, holding time, and consistency of execution. Without entry and exit rules, Traders are far more likely to react emotionally to price movement instead of following a repeatable process. Clear rules make decisions more stable because the important choices are made before money is at risk. They also make a strategy easier to test, since you can evaluate what would have happened under the same conditions in the past. In that sense, entry and exit rules are not minor details. They are the core mechanics that turn an idea into a tradable system. It helps to separate a signal from a rule. A signal is simply a clue that something important may be happening, such as price moving above resistance or momentum turning upward. A rule turns that clue into an exact instruction by specifying the action, the price condition, the order type, and often the timing. For example, saying a breakout looks interesting is a signal. Saying buy if price trades above 150 using a stop order valid through today's close is a rule. That difference matters because rules remove ambiguity. If two traders read the same rule, they should reach the same decision, which is exactly what makes a strategy testable and repeatable. A trading rule is only complete when it specifies the practical details of execution. It should say what asset is being traded, what exact condition triggers the trade, what order type will be used, how large the position should be, and whether there are timing limits such as only trading during a certain session. Without those details, a promising setup remains incomplete. For example, noticing that Euro/USD is breaking resistance is not enough by itself. You still need to know whether you enter with a stop order or a market order, how much capital is at risk, and whether the trade is valid outside the London session. These details may sound operational, but they strongly affect real results. A good rule is not just descriptive, it is executable. Entry triggers can come from several sources, but they need to be objective enough that the same setup is recognized every time. A breakout above resistance or below support is a common trigger, especially when paired with volume as confirmation that the move has participation behind it. Another popular approach is a moving average crossover, where a shorter average crossing a longer one signals a possible shift in direction. Some systems use indicator thresholds, such as RSI moving out of an oversold zone and back above a level like 30. The specific trigger matters less than the clarity of the definition. If the entry condition is vague, then testing and execution become unreliable. A useful entry rule tells you exactly when observation turns into action. Exit rules do two jobs at once. They limit downside and they define how profits are taken. A stop loss is the most basic protective exit, because it sets the point where the original trade idea is considered wrong enough to close. A profit target does the opposite by locking in gains at a planned level. Some strategies use trailing stops instead, or in addition, so that a winning trade has room to continue while still protecting part of the gain. Time exits are another tool, closing the trade after a set number of bars or days if the market has not moved as expected. Strong strategies usually include at least one rule for protection and one for opportunity. Exits are not an afterthought. They are a major part of the strategy's risk and return profile. A practical way to design rules is to define the trade in sequence before it ever happens. Start with one objective entry trigger, something clear enough that another trader could identify the same setup. Then choose the order type, because entering at market, by limit, or by stop can change your real fill and your results. After that, set the initial stop loss at a level that tells you the idea is wrong, not just at an arbitrary distance. Define how profits will be taken, whether through a target, a trailing stop, partial exits, or a combination. If timing matters, add that too, such as an end-of-day exit or a maximum holding period. This step-by-step structure keeps the strategy coherent and prevents important decisions from being improvised during the trade. How you enter a trade matters almost as much as why you enter it. A market order seeks immediate execution, which is useful when speed matters, but the actual fill may be slightly worse than expected. A limit order gives more control over price, but the trade might never get filled if the market does not return to that level. A stop order activates when price reaches a trigger, which is why it is often used for breakout entries. All of these choices affect real-world performance, especially once slippage is considered. Slippage is the difference between the price you expected and the price you actually received, and small differences can add up across many trades. That is why execution details belong inside the strategy, not outside it. Stops and targets work best when they are tied to the market's structure or volatility. A stop placed below a recent swing low, for example, has a logical meaning. If price breaks that level, the trade idea may no longer be valid. Another approach is to use volatility measures like ATR. So the stop reflects how much normal price movement the market tends to make. This can help avoid getting stopped out by ordinary noise. Profit taking should also match behavior. In a range-bound market, a fixed target near resistance may make sense, while in a strong trend, a trailing stop may be more appropriate to stay with the move. The broader principle is that risk controls should respond to market behavior, not to arbitrary numbers. A complete trade plan turns a general signal into a specific executable strategy. Suppose on an AAPL daily chart, the 20-day moving average crosses above the 50-day moving average. That is only the beginning. The plan becomes real when you say you will buy 100 shares at the next day's open, place a stop 2% below entry, aim for a target equal to 1.5 times the stop distance, and exit at the market close after 20 trading days if the trade is still open. Once those details are written down, you can calculate expected risk, reward, and even realistic frictions like slippage. This is what makes a strategy testable. The edge is not in the signal alone, but in the full set of decisions around it. When writing rules, the goal is clarity, without unnecessary complexity. Vague triggers such as buy when the market looks strong are hard to test and easy to reinterpret after the fact. It is also a mistake to ignore order types, because a market order, limit order, and stop order can produce very different fills. Good rules usually include both protection and profit taking, rather than relying on only one type of exit. They should also account for costs like spread and slippage because gross performance can look much better than net performance. At the same time, adding too many filters can make the strategy fragile and overly tailored to the past. Strong rules are specific enough to follow, but simple enough to remain durable. Section 4. Backtesting. Backtesting applies a strategy to historical data so you can see how it would have behaved before risking real money. If the rules are clear, past prices can be used to generate trades, build an equity curve, and estimate performance measures like return, drawdown, and win rate. This makes backtesting a valuable early filter for ideas. A weak concept can often be exposed quickly, saving time and capital. A promising result does not prove the strategy will work in the future, but it can show whether the logic deserves deeper study. That distinction matters. Backtesting is evidence, not certainty, and it is most useful when treated as a discipline screening tool rather than a prediction machine. A backtest can look impressive for the wrong reasons if the assumptions are too generous. Bad or incomplete data can distort signals and create trades that would never have existed in real conditions. Ignoring commissions, spread, and slippage can make frequent trading strategies look far more profitable than they really are. Unrealistic fill assumptions can have the same effect, especially in fast or less liquid markets where getting the exact expected price is unlikely. That is why realism matters so much. A modest backtest built on believable assumptions is usually more valuable than a spectacular one built on fantasy. The goal is not to make the strategy look good on paper, but to make the test resemble live trading as closely as possible. A sound backtest depends on both the quality of the data and the realism of the trading assumptions. The data must match the market and time frame being tested, whether that means daily bars, intraday data, volume information, or adjustments for things like stock splits and dividends. Then, the test must model costs such as commissions, spread, and slippage, because those can materially change results. Execution rules also need to be clear. If a signal appears on a daily close, does the trade enter at that close, the next open, or somewhere else? In less liquid markets, market impact may matter too, especially for larger orders. A useful backtest is not just a strategy applied to price history. It is a strategy applied to price history under realistic trading conditions. A consistent backtesting workflow helps prevent hidden errors and makes results easier to trust. The process begins with exact entry and exit rules because vague logic cannot be tested properly. Then you choose the market, the time period, and the bar interval so the test matches the intended use of the strategy. After that, you model execution details and trading costs, including things like slippage and commissions. Only then do you run the simulation and review the output. This structure matters because every assumption influences the final numbers. When the workflow is repeatable, it also becomes easier to compare variations honestly instead of changing several things at once and losing track of what actually improved a strategy. Consider a simple example using Apple daily data from 2020 through 2023. The strategy buys when the 20-day moving average crosses above the 50-day moving average, but only if the prior 5 bars were below the 50-day average, which acts as a filter to reduce noisier entries. It sells when the 20-day crosses back below the 50-day. Even in a straightforward system like this, trading assumptions still matter. You might assume 1 share per signal, $5 in commission, and 0.1% slippage on both entry and exit. Those details may seem small, but they affect the final result. This is why a backtest is not just about the signal logic. It is about testing the complete trading process. Once a signal appears, the trade has to be translated into a realistic calculation. If the entry close is $230, but slippage pushes the actual fill to $230.23, that extra cost needs to be included. If the exit close is $380, but slippage lowers the actual proceeds to $379,720.62, that reduction must also be counted. Then commissions are applied on both sides as well. In this example, the gross move is large, but the net profit becomes $139.39 only after subtracting those frictions. This is an important habit in strategy design. Costs do not just apply in the abstract. They affect every trade and can materially change what looks profitable at first glance. Reading backtest results means looking at return and risk together rather than focusing on profit alone. Total return tells you what the strategy earned, but maximum drawdown shows how painful the path may have been. The Sharpe ratio adds another layer by relating returns to volatility, helping you judge how efficiently those returns were achieved. Win rate can be useful, but it should be interpreted alongside average trade duration and the size of wins versus losses. Trade count matters too, because a result built on many observations is generally more trustworthy than one built on only a handful. A strategy with lower return but steadier behavior can be more practical than one with higher return and deep drawdowns. Good evaluation always asks what kind of experience the numbers imply for a real trader. Metrics only become meaningful when you ask what behavior created them. A high win rate may sound impressive, but if the strategy occasionally takes very large losses, the overall result can still be poor. On the other hand, a lower win rate may be perfectly acceptable if the winning trades are much larger than the losers. Strong results can also be misleading if they depend heavily on one market regime, such as a bull run that favored almost any long strategy. That is why benchmark comparison matters. If a strategy barely outperforms buy and hold while taking similar or greater risk, the edge may not be very compelling. Numbers are useful, but they need interpretation, not admiration. Several common mistakes can make a weak strategy appear stronger than it really is. Survivorship bias happens when failed or delisted stocks are left out, which makes historical performance look cleaner than real investors could have achieved. Look-ahead bias is even more dangerous because it sneaks future information into past decisions, creating impossible trades. Over-optimization, which we will examine more closely in the next section, fits the strategy to historical noise rather than to a durable edge. Testing only one market regime can also give a false sense of confidence, since a strategy that worked well in a bull phase may fail badly elsewhere. Ignoring trading costs adds yet another source of distortion. Any one of these errors can change the conclusion of a backtest dramatically. The practical goal of backtesting is not to find a strategy that looked perfect in hindsight. It is to judge whether the idea is logical, promising, and realistic enough to deserve more testing. That means using clear rules, clean data, and assumptions that match actual trading conditions. It also means evaluating both return and risk, rather than chasing the biggest headline number. A good backtest gives you evidence that the strategy might have merit, but it does not remove uncertainty. Markets change, and live execution is always messier than historical simulation. So the healthiest mindset is to treat backtesting as a disciplined filter for ideas, not as proof that future profits are guaranteed. Section 5. Overfitting. Overfitting happens when a strategy is tuned so closely to past data that it captures random quirks instead of a repeatable market pattern. The result can be a backtest that looks unusually strong, with smooth performance and impressive statistics. But the strategy may only be matching accidents of history rather than a durable edge. When conditions shift or new data arrives, that apparent strength often disappears. This is why paper performance can be misleading. A model that explains the past perfectly is not necessarily useful for the future. In strategy design, the real goal is not maximum historical fit, but reasonable performance that can survive outside the original sample. A simple way to picture overfitting is to imagine drawing a line through scattered data points. A very jagged line can be bent enough to pass through every past point, but that perfect fit often reflects noise rather than true structure. A simpler line may not hit every point exactly, yet it often does a better job when new data appears. Trading systems face the same issue. If you keep adding filters and adjustments until the backtest looks ideal, you may just be building a complicated explanation of old randomness. Perfect fit is not the objective. The better objective is a model simple enough to capture the broad pattern and flexible enough to generalize. Overfitting often begins during optimization. A trader starts with a reasonable idea, then tests many versions by changing moving average lengths, entry thresholds, stop distances, targets, indicator settings, and other details. After enough variations, one combination usually stands out with the best historical result. The temptation is to assume that this winner must be the best strategy. But searching through many combinations increases the odds of finding a lucky result, even if no true edge exists. In other words, the optimization process can accidentally reward noise. A strong-looking backtest is not automatically evidence of a strong strategy if it was selected from a very large search. The best-looking backtest can actually be the worst choice when it wins mainly by chance. If you test enough combinations, some will produce exceptional metrics simply because random variation happened to line up in their favor. That does not mean the rules are meaningful. It may only mean the strategy fit a specific sequence of historical events unusually well. This risk is especially high when the setup depends on narrow timing, rare events, or many interacting parameters. In those cases, the strongest historical result may be the least credible one. Spectacular numbers should make you curious, but they should also make you cautious. Overfitting often follows a familiar pattern. It begins with a reasonable strategy idea, then expands into many rule variations or parameter changes as the trader searches for better historical performance. One version eventually rises to the top, often with a very attractive in-sample equity curve. At that moment, it is easy to believe the optimization process discovered a superior edge. But when the strategy is exposed to new data, the strong result may fade, because the chosen variation depended on noise rather than on durable behavior. This sequence is common precisely because the mistake feels like progress. The more aggressively you search, the easier it becomes to find a lucky historical winner. One of the best ways to check for overfitting is to test the strategy on data it has not seen before. In-sample data is used to build or tune the strategy, while out-of-sample data is held back to evaluate whether the behavior carries over. If performance drops sharply on that unseen data, it is a warning sign that the original result may have been fitted too tightly to the development period. Forward testing adds another layer by watching how the strategy behaves on new incoming data after design is complete. None of these methods can guarantee success, but they can reduce false confidence. A strategy that holds up across development, validation, and forward observation is usually more credible than one that shines only in the original sample. Imagine a breakout strategy that was optimized across 50 lookback settings and 50 stop-loss settings, creating two 500 combinations. One setting, using 17 bars and a 1-8% stop, produces remarkable in-sample results, including an 85% win rate and a profit factor of 4.2. On paper, that looks exceptional, but when the same strategy is tested on new data, the win rate drops to 35%, and the profit factor falls to 0.7. That sharp deterioration suggests the chosen settings captured something specific to the original period rather than a repeatable edge. The lesson is not that optimization is useless. It is that standout performance after a large parameter search should be treated with skepticism until it survives unseen data. This kind of example teaches an important habit. Do not confuse the most impressive result with the most trustworthy one. A parameter set that produces one spectacular period but weak or uneven behavior elsewhere may simply be overfit. A slightly less exciting version that performs reasonably well across several periods is often the better choice. In strategy design, consistency matters more than peaks. Durable performance usually looks modest and stable, not magical. That is why robust strategies often appear less glamorous in the backtest summary. They win credibility not by dominating one sample, but by holding up across time. Suppose a setup appears only 4 times in the data and all 4 trades are winners. That looks perfect at first glance, but it provides very little evidence. A tiny sample can produce flawless results purely by chance, especially if the market environment happened to be favorable. 4 wins do not tell you much about how the strategy behaves across different conditions, costs, or execution realities. This is where out-of-sample testing and forward testing become essential. Simpler rules help as well, because they reduce the chance that the perfect record is just an artifact of fitting. In strategy evaluation, a perfect result from too little data should create caution, not confidence. Reducing overfitting risk starts with accepting that the goal is not to explain the past perfectly. A stronger goal is to build a simple, logical strategy that performs reasonably well on data it has never seen. That means reserving unseen data for validation instead of using every available chart to optimize. It also means limiting unnecessary parameter tuning and resisting the urge to add rules only because they improve the backtest. In practice, robust strategies often look slightly worse in sample than overfit ones, but they hold up better later. A backtest that is less spectacular and more durable is usually the more valuable result. That is one of the most important lessons in all of strategy design.